Hi, I'm Dave Anderson, and I'm excited about the AP Business with Personal Finance course. This course talks about the cash flow statement in Unit 3.8. It's also in Module 3.8 of the textbook. Definitely fair game for the test, but it has some confusing elements, so I want to talk about this. The cash flow statement is like a glimpse into the cash drawer of this business. Let's suppose this is the cash flow statement for Doug's Mugs, and these numbers apply. Let's talk through why they are there. Net income comes from the income statement, and this is just the amount of revenue collected by the company minus the cost of goods sold, the income tax expenses, the selling, general, and administrative expenses, and that gives us a starting point. But we want to think about what adjustments need to be made based on what's really in the cash drawer for this company. Increases in accounts receivable are subtracted. This negative sign and these parentheses mean we're taking that number out of the 70,000 when we're thinking about how much cash is being added to this company. Accounts receivable is an amount that is part of the sales of this company. They sold mugs for that value, but they haven't collected that money yet, so the cash isn't in the drawer yet. So we subtract out the amount of accounts receivable because the money isn't there yet. An increase in inventory is also a subtraction, and that can be confusing because we're wondering, why isn't that captured in net income? Why wasn't this inventory expense captured in the $70,000 that we already have there? This is because inventory is not part of cost of goods sold. If there is a net increase in inventory, we are buying more mugs than we're selling, and so the value of those mugs that we're buying but not selling is not part of the cost of goods sold that's subtracted in the calculation of net income. So we want to subtract out the $10,000 worth of mugs that we added to inventory but didn't sell and therefore are not here. It could also be that inventory decreases, and let's talk about a numerical example there. Suppose that the price for a mug that is sold is $12. The mugs cost $5 for Doug's Mugs when they buy them and add them to the inventory. And in one period, let's suppose that Doug sells 20 mugs that were in inventory and buys 15 more. So there's a decrease, a net decrease in inventory of 5 mugs. The revenue from that sale would be the 20 mugs times $12 each, $240. The cost of goods sold is the 20 mugs times $5 each. That's their price to buy the new ones, $100. So net income, the value that we have to begin with, is 240 minus 100, $140. But inventory dropped by 5. 5 of the mugs that were sold were not replaced. So we're kind of cashing out of some of that inventory. Remember, we said that when we bought the inventory, we subtracted the cost of the inventory when we bought it because that's cash out. If we're not replacing all of them, we are not deducting the full $100. Our cash increases by the $240 minus the $75 that we spent on the 15 that we bought, but not the full $100. So if we kept this $140 from net income, we would be double counting the cost of those 5 mugs that we deducted when we bought them and deducted again as cost of goods sold. So we correct for that by adding in $25 for the decrease in inventory. The 5 mugs sold and not replaced were worth $25. We already counted that cash going out, so they don't want to count it as cash going out again. If we have an increase in accounts payable, that means that there's some money that we owe that we haven't taken out of our cash drawer yet. So we want to add that. It's money that's sitting in our drawer, even though it was part of the expenses of net income. So it was counted here, but we didn't really put the cash out. We need to add it back. If we add up all of those values from operations, we see we gained $54,000 in cash. Then we look at investment activities. If we purchase equipment, that too is not part of the net income calculation. Equipment purchases aren't cost of goods sold. They're not any of those categories that go into net income. So we want to take that out. That's cash that's been spent, not already captured. If we sell investments,
maybe we have real estate that we sold,
we collect cash from that. That's added as a positive value. And we add those up to get the $14,000 decrease in cash in the investment category.
And then we have financing activities.
If we have a bank loan, that's cash coming in. So we add that. If we pay dividends, that means that we're taking some of our profit and paying it out to investors. So that's cash out, and it's subtracted. The net of those is found by just adding the 20,000, subtracting the 12, we get 8. And then each of these net values is added up to get the net cash flow of 48,000. We add to that the cash that was already in the drawer when we started this period. That was 16,000 for a sum of 48 plus 16 is $64,000 of cash in that cash drawer. I hope some of that makes better sense now. Stay curious.